and thanks for joining us on today's Ask Jane episode. For those that are not aware, I'm a relatively new starter with AdviceWise. My name's Craig Faulkiner and I've joined as Head of Distribution. I'm very pleased, as always, to be joined by Jane on today's call. We're going to be looking at some of the overarching issues with equity release. Brokers often get in touch with Jane and our help desk, not only to see where they can place cases, but to understand why certain criteria is in place and the challenges that creates. So thankfully, Jane, as our resident expert, is going to be talking you through some of the common areas, just to have a look in terms of why it can cause a problem and potential solutions that you can look at as well. I'll just hand over to Jane just to say good morning.
Good morning. Hello to everyone for joining me again. Thank you.
So I'll be asking the questions today, and thankfully Jane will be answering them for us. So we're actually looking at two particular areas today. We're going to be looking at people in terms of the customers, the clients, and what challenges that can raise, and then the purpose as well. So quite often you may have tricky conversations with compliance departments, networks, and things like that when it comes to the criteria and why properties can be a problem as well. So you'll see that today's session will be split into two. We've made it nice and straightforward. So first of all, let's get on with the first question. So looking at people and clients. So first of all, Jane, will all lenders allow tenants in common?
Most will lend tenants in common, and they prefer to do it that way or joint tenancy. But we do have Liverpool, Victoria that don't like tenants in common on any of their products. So it has to be joint tenants. Which doesn't, you know, for some people that causes a problem, obviously with second marriages and things like that. Tenants in common are preferred in some cases. Okay, so most, but not all.
Lovely. And I realise that's an area that's becoming more and more common, as you say, Jane, with everybody having different individual circumstances. So certainly something important to check with your customers. I think also as well, checking the reasons why it was set up in tenants in common and making sure that doesn't have any other knock-on effects that could be detrimental to taking equity release. Next question, will lenders allow married couples to apply in single name?
With that is becoming more and more of an issue now as more and more lenders refuse to actually do it in a single name. So we're only actually left with two lenders, which is Canada Life and Pure, that will consider that. But obviously, if you're doing that in a single name, that you have to bear in mind that the other party, or the occupier, will be possibly homeless in the event of death or long-term care. And also, you would need to sign a waiver of occupancy.
Yeah, I know certainly coming from my previous experience with an equity release, as you say, Jane, it's few and far between in terms of the lenders that can allow it. I believe that the issue mainly being when it comes to marital rights when that first party has passed away. So great that there are a couple of lenders out there that can still consider that, but as you quite rightly said, Jim, you're likely to need an occupier waiver. Also, the client that is not going to be named on the plan does need to take independent legal advice. That's always essential and an absolute requirement of the lenders that do allow that, because naturally they are giving over certain rights to the property. They need to understand the ramifications of doing so. And I think it's fair to say as an industry, the reason why many lenders don't do it, they try to create a situation so that it's not encouraged. The last thing that we want is a situation where one of the parties passes away and the remaining spouse is left in an awkward situation. So by far and away, if it is possible to do it in joint names, generally most advisors will advise it being done that way. But for those essential cases, there are at least a couple of homes for it. Moving on to the next question. So the minimum time allowed within the UK. So we're looking at residency here in terms of how long the customer must have been resident in the UK.
Well, the instructions have to be taken for the lifetime mortgage while they're on UK soil under the FCA rules and guidelines. However, there is actually no minimum time with some of the lenders. So the likes of Aviva and Canada Life will consider an application on day one. The other lenders prefer something in the region of 6 or 12 months, or even 3 years for the voters roll and for the credit file history.
Perfect. So generally speaking, 3 years is ideal. Some lenders will consider less, but again, probably just a select amount of lenders that will allow maybe less than 6 or 12 months. But as always, this criteria can tweak and change, and sometimes there are opportunities to build a case. So, again, I think that's where the importance of using a help desk like ourselves, and obviously there are others out there, is where it's key, because the criteria can be updated at any time. And sometimes there are individual circumstances that may mean you can get an exception as a result. Next, we're going to look at clients with adverse credit. So we'll approach the main three. I think these are the three that we tend to hear time and time again. But if a client has an IVA, Jane, how does that affect their options?
Well, it does certainly restrict their options, because obviously an IVA is the next thing to a bankruptcy. So it's very important that it's gone through the courts, and the courts have agreed on a payment that the client has to make. Failed to make it, they could repossess their home. So an IVA is pretty adverse. The lenders would expect the IVA to be repaid at completion. Not all lenders would accept an IVA, but we do have a couple like Canada Life, Aviva, that would accept an IVA as long as it's paid off at completion, and it would have to be an undertaking on the offer for the solicitors to comply with that.
And looking at debt management plans, how does that affect things, Jen?
Well, that certainly affects them, because obviously it's an arrangement with creditors to repay debt. And in most cases, the lenders, whilst they're happy that the client has actually got some adverse on their file, they would require that to be redeemed at completion, so that there's no risk of that being a problem in the future and going to an IVA.
Okay, perfect. So with the debt management plan tends to be a less restrictive than IVAs then, but
Yep.
can still create that problem, and appreciate different lenders will have different views as to the payments, the amounts and things like that. And I think also from my experience, you often find lenders, when they're asking additional information around this adverse kind of scenarios, quite often they're interested in the reasons why, what caused that situation. That can sometimes get a more sympathetic ear, obviously, if it was forces beyond their control. So always worth getting as much detail from the customer as you can. And finally, obviously, the final of the big three that we tend to see when it comes to adverse credit, but I think probably more common, CCJs, county court judgments.
Yeah, county court judgments, most of them will accept them, again, as reason. And I always say to be honest on the application form. So anything up to normally up to £10,000, they will accept, but again, they want them redeemed at completion. So they're sympathetic. I think the fact is that lifetime mortgages, you don't have to make a payment, so therefore they're a little bit more softer approach to some adverse. And obviously lifetime mortgages can be used to clear adverse and put peace of mind.
Perfect. And I think you make a great point there as well, Jane, is, from a lot of stereotypical mortgage brokers that are sort of first venturing into equity release and are seeing some of the differences and challenges of the two markets, a lot of them would quite justifiably think, well, why is adverse credit a problem? The credit worthiness is not necessarily a problem to the lender. But as we say, a lot of it is the devil in the detail, is what caused that situation. An equity release lender is quite happy to be seen as a solution to get out of that problem. But if they're simply pushing that further down the grass and finding, that the customer may get into the same situation again, they've got a repeat history of getting into these situations, then really it's for the customer's own benefit that they look at the wider picture as to what's causing it, and not just be another solution and find years down the line that they're in the same position again.
Yeah, it's because if you've got a leasehold property and you've got ground rent and service charge, that the adverse does take, or they take more interest in the adverse, because obviously they don't want to be in a position where they have to actually find the funds to service it if the client can't.
Yeah, very good point. So looking on to the next one, clients that are receiving means-tested benefits, or I suppose benefits in general, but means-tested tends to be the buzzword within equity release. So if we just approach these one by one very briefly, if we're looking at pension credit.
Pension credit is for those who are of state pension age. So varies from 65 now going through to 66. You can't have any more savings than £10,000. If you have more than £10,000, for every pound, for every £500, it's worth £1 in savings. So therefore, the whole idea of this is the setting of a minimum fund release at 10,000. It's not to affect your pension. So it's worked on income, and any shortfall in income is made up to a benchmark figure. And we do have systems, entitled to or turn to us, that will help you assess each client, and they're free to use. You can also purchase free Ben, that's about £45 a year, or you can do Fintal reports, which are far more detailed to help and support you. But you don't want to be unlocking money that will affect this benefit, because it's quite important to them.
Perfect. And I think you're right there, Jane. The tools that are out there are absolutely invaluable to anyone that's going to be speaking to our demographic of customer. Obviously, equity release is a minimum age of 55. So we're not just looking at a situation of do you receive any benefits that equity release would impact, but indeed, you may be the final financial advisor that that customer sees. It might be that you open their eyes in terms of benefits that they didn't realize they were entitled to. So those systems are very good, not just necessarily to give the best advice and make sure the customer doesn't lose out on any money they already get, but also to identify whether or not they could be entitled to any more, which may then mean they don't need as much from equity release, or maybe don't need equity release at all. Moving on to attendance allowance, please, Jen.
Attendance allowance is not means tested. It's normally because you're not able to do 2 of daily tasks, i.e. put your socks on or boil a kettle. And that's usually given to the person to allow them to pay for services from people to provide help in their daily living. It could be getting a taxi, it could be to the wife, making the cup of tea. So between them, it varies. There's 2 levels of attendance allowance depending on your ability. But something that's not obviously shown on the entitled to, but you can get help and support from your benefit office on this, and they're constantly reminding people to apply for it. So it's not means tested, so it doesn't affect any other benefits.
Perfect. And obviously the nail on the head there, Jane, is and the phrase that you'll hear so often within equity release: is it means tested, is it not? If it is means tested, it can be affected. If it's not means tested, then equity release isn't going to have that impact. Would I be right in thinking then, Jane, that carers allowance and things like that are non-means tested?
That can be means tested, actually, if somebody's working so many hours. So it can affect, that's the one benefit that it can affect. So if you're working 16 hours or more, then and you're claiming carers allowance, then it is means tested to make sure that you're not getting perhaps more than your fair share. The other one, which we didn't mention, was the council tax relief, which if you're a single person, you automatically get your 25% as long as you've applied. For those with savings over the £16,000, they would no longer qualify. So that's something to be mindful of, and that is if you're receiving state pension, and also if you're on universal credit. So it's checked every year, the assessment is made, and they may give you a percentage, or you may even get full benefit, which can be worth quite a lot of money, sort of £140, £200 a month.
Indeed. So yeah, I mean, certainly, I think just purely from that very short segment there, it's clear that benefits can be a tricky area to navigate through. I think, again, it's safe to say, as a mortgage advisor, as an equity release advisor, as a holistic IFA planner and everything else that goes with it, ultimately these systems can be worth their weight in gold in terms of helping give you the guidance that you need to make sure you're giving the most effective advice possible. Just to wrap up on that particular area then, Jen, mortgage interest support, which I would imagine, given the lockdown and corona situation that we've faced, is probably something that we're going to see more and more in the coming months.
Well, the mortgage interest support, again, is for the lower income. And again, it's now given as a form of a loan. So it's a charge registered on the property now. No longer is it a benefit, it's a loan from 5th of April 2018. So you need to be mindful of that, because obviously if you're doing an equity release and they are in receipt of that, then that means that loan would stop, and therefore, and then would have to be repaid to the local authority.
Right. So yeah, so it's certainly a lot to watch out for in that area. And again, I think ultimately it's just a case of having as robust a conversation and fact find with your customer as possible to be able to find all this information and see what they do and don't receive, and then take it away and obviously make a fair assessment. So we're going to move away from adverse credit now. The next topic is raising funds if in poor health.
Well, certainly you can raise funds in poor health, and we do get a lot of that at the desk, to be honest with you, usually to pay for carers coming into the property, because nowadays it's not free, it's like a taxi meter. So therefore, if you do have assets, funds, savings, then you do have to pay a percentage or all of the care, because the local authorities just haven't got the funds to pay for it. So you need to be careful, obviously, when unlocking money, to make sure that you don't unlock too much. And you also need to remember, if you are in poor health and you're unlocking money for things like gifting, you've got the deprivation of assets under the Care Act 2014 to remember. So you can't just sort of release the money to avoid paying for your care, both now and in the future. And there is no time limit on it. So you need to be mindful of that. So yeah, you need to cover it off on if you've got somebody that's poor health in your fact find and in your suitability letter, the importance of the gifting if that's what they're doing.
Indeed. And I think certainly care becoming more and more of a prevalent area of equity release, people wanting to make sure that they've got the best quality of care that they can afford, really. But as you say there, Jen, it's a lot used to fall on the local authorities, and unfortunately now they're pushing more and more back. So we're seeing many people using equity release purely to get the style and level of care that they wish to enjoy in their later life. The next one, maybe not quite as frequent, but I think certainly these are becoming more and more well known and heard of. So raising funds under an LPA, a lasting power of attorney. Alternatively, there may be a historical one, an enduring power of attorney. So we're looking at power of attorneys in general, but nowadays the more modern ones tend to be written as lasting power of attorney. How would that affect their equity release proposal, Jane?
Well, that's becoming more and more now, again, usually to pay for care. The lasting power of attorney means the person that's named on there as attorney is responsible to the courts, so that they are looking after that client and therefore has to justify every move to the courts if they need to. So they need to keep proof and evidence of what they're doing and how they're doing it. I think the key thing is here that you can't just take money out on behalf of that person for luxuries. You can't go and build a swimming pool in your garden. The idea is it's for that person and that person's care and well-being in the home if it needs altering, to adapt it for them. An LPA for a spouse just doesn't work in our market, unfortunately, and quite often we get lasting power of attorneys where there's no other person named on the attorney. So you can't sign the application twice. So you can't sign for yourself and you can't sign for your spouse if you've got an LPA on your spouse. You do need another party, whether it's family, solicitors, friends. We get a lot of those, and it ends up then having to go back to the courts for a deputyship, which is not cheap, takes an awful lot of time, and it's about £1,800. And in the current climate, it's hard to achieve. So just be mindful. And it is actually important when you're doing the fact find to advise your client that they need to consider this, especially when you have a drawdown facility. Because later in life, if you haven't got one and you do need one because of incapacity in one way or another, then you won't be able to access the additional funds without going through the courts, through the deputyship again.
Indeed. I think that's probably the number one rule that I've always tried to abide by with powers of attorney, whether they're setting up a new one, whether they have an existing one. Try and get more than just one person that's able to sign. And certainly when it's a joint couple, make sure that whoever is able to sign on behalf of that person is independent of any potential future financial decisions. Otherwise, it does create that conflict of interest where a husband can't sign for wife and vice versa. And we're down to the last few questions now. So if we're looking at, again, something becoming more and more frequent, a long-term partner residing in the property. So they're not married, maybe they've had previous marriages, maybe they've been single all their life, but they're now in a position where they have a long-term partner that they live with, but they're not physically married.
Well, lenders have different views on this one. Most are okay, but we do have two lenders that prefer it to be in joint, well, not joint names, but both on the title. With legal in general, they're quite happy to accept tenants in common, whereas Liverpool, Victoria do want them to be joint. So again, be mindful of this as it may affect your choice of recommendation.
Okay, and would the same apply when it comes to lodgers?
Lodgers are different. And lodgers come in various different formats. Again, most lenders are okay with lodgers, providing that they're sharing the kitchen and the accommodation hasn't been separated in any way. And as long as there's no separate utilities, most lenders are fine. With obviously legal advice and sign a waiver of occupancy. It's when you come to a separate unit, so like an annex, then that becomes I won't say troublesome. It's more if you've got family and friends in the annex and no separate utilities, then it's fine. When you've got separate utilities, it becomes more of an issue because it's more, you tend to find you've got tenants in there with an AST. But again, we have got lenders that will look to assist with those. So you need to ask the questions, separate utilities, separate access, any internal doors, and what's the arrangement.
Perfect. And final on that particular area, if you have children residing in the property, is that treated the same way as lodgers?
They are treated, obviously, anyone under 17 doesn't have to go and get separate legal advice or sign a waiver of occupancy. But it's mindful as you an advisor of children are residing there that you let them know that they will become homeless or what's going to happen to them if they're young children. And we do get children that are unfortunately disabled living, and the lenders can ask for something from the local authority to confirm that they would obviously cover a home for them in the event of the parents leaving us, for want of a better word. So but yeah, just call us and ring us and we can guide you on that one, because each lender has a slightly different view.
Perfect. And final question now for looking at people and clients. When clients spend, say, half their time abroad in another home, is that something that's allowable with some lenders?
The important thing here is to check the KFI with the lender, and it will specify what time the property or how long the property can be left at any one time, up to about 3 months. So you can find that, if you're only doing like 10 weeks here, 10 weeks there, 10 weeks here, 10 weeks there, that's fine. Any more than 3 months can be an issue. Some lenders will go as long as 6 months without it being occupied. Otherwise, they reserve the right to repossess under the terms and conditions. And you obviously need adequate building insurance.
Yeah, and I think that's the another key point there is that the reason why a lot of lenders don't allow more than 3 months is, little did I know until I was re-educated on the matter, that a lot of insurance policies are invalidated if the property is left unoccupied for over 3 months. So the lender's almost got a double whammy where the client's not going to physically be there, but then is the insurance actually valid 3.5, 4 months down the line? And touch wood, God forbid, if they have a major leak, a flood, anything like that, and they're not around to fix it, and they're not insured, you can understand why it would give lenders a purpose for concern there.
Yeah, but we do get quite a few that do have second homes, in France, Switzerland, Spain. They like the summer here and the winter over there. So nice to be in that position.
Indeed. Yeah, certainly one day, hopefully. But I think, as you mentioned there, Jane, a great point is that's not to necessarily say that they can't enjoy extended time and periods away. They just need to make sure that they do it within the confines of their plan and their agreement with their lender, whether that is 3 or 6 months, doing 10 weeks here and 10 weeks there, and they can hopefully enjoy the best of both worlds. Thanks very much for that, Jane, and I hope that you all found that quite informative. As we say, the criteria can be a slightly moving object within equity release, so always good to make sure that you've got up-to-date information and that you are utilising the support that you have from Help Desk and things like that. And as always, we're more than happy to help on the AdviceWise Help Desk if you do have any particular queries, or indeed want to get a little bit more information on that. So I'll thank you again, Jane. That was very, very informative. That concludes today's particular session. Tune in for the next one where we'll be doing a very similar format, but we'll be looking at the purpose of why people take equity release, what they're using the money for, and what challenges that can present to lenders as well. Thanks very much.